Good evening, everyone, and welcome to Tideway's spring webinar. My name is Seymour Banks, and I am delighted to be joined this evening by James Baxter, who I'm sure all of you know as the founder of Tideway, and also Sam Ratnich, who's one of our senior wealth managers. This is our second webinar of 2024. The first one we held was in January. The focus was completely investment related. And for those who attended, you may remember we were looking back at 2023 and positive performance in 2023. But at the same time, looking forward to 2024 and the various challenges ahead, both economic, but also geopolitical, which loomed large, certainly at the time, and seem to loom larger even now. Hopefully tonight, broadening out our exposure, not just to investment performance, and we will reflect a little on the first quarter's investment performance, but also to financial advice. And we will be discussing some of the opportunities and changes arising as a result of the Hunt Spring budget. But we would appreciate and invite comments and questions from everyone this evening. They can be related to financial advice, they can be related to investments, but also business. So the whole gamut in terms of the opportunity set. And before I start, for compliance purposes, just to reiterate that the views expressed here tonight are personal. They are subject to change, and in no way do they constitute investment advice. So that's the introduction over. James, to start off with a question for you, a business-related question. It's one actually which we've received from a number of our clients, and it's related to the appointment of Neil Croxford as Tideway's new CEO. Actually, the questions aren't so much to do with Neil, they're very much to do with you. And what does that mean for your role at Tideway going forward? Does that mean you're taking a backward seat?
Yeah, well, thank you, Seymour. Thanks for the introduction. And I hope we can entertain you for an hour. We've all put the right shirts on, various shades of blue. Yeah, no, my role isn't going to change much at all. And in fact, Neil has pretty much been running the business for a few years now, really, as I've been less and less involved on the day-to-day management. And that just means that I can really focus on what I like doing best and what hopefully brings the most value to the business and our customers. So I'm focused really on the investment markets with Nick Gates, our investment director, and I'm working hard with him on a sort of regular basis to try and keep our portfolios as optimally invested as we can. And then I'm working with the other advisors to try and help them with any issues they get, although these days technically they're much better than I am, and Sam particularly is now more qualified than me, and so regularly I end up going to them now for technical advice on advice matters. But also with Seymour, I'm working very much on the business development, and I'm delighted to have a prospect list of nearly 100 million of client monies that we're working on at the moment, doing a bit of advice on with a view to hopefully managing some of that money in the next few months. So for me, it hasn't really changed very much, and it's business as usual, and I like it. And so as long as I'm adding value and the guys will have me, I shall be around for a few more years yet.
Well, it sounds like very good news. If you're happier, James, then I'm sure that will spread throughout the whole business, and in particular, having more time to spend with clients certainly will add value, I'm sure, in many respects. Thank you for that. Right, so we talked about broadening out the focus for the webinar and including financial advice. Sam, as our senior wealth manager, one of the senior wealth management team, do you have any comments? Why is now a particularly good time to be talking about financial advice?
Well, we're in the new tax year, so the new tax year, the first working day of the new tax year is today, and we're just done it. So everyone on this call has a new ISA allowance, they have new pension allowance. You know, there has been a few changes from the recent budget, you know, fairly small, I would say, really. You know, the national insurance payments have gone down for those who are paying earners. If you're selling a second property, your capital gains tax has gone down. I think the biggest news actually is really there's not that much news. You know, income taxes have been frozen. They've been frozen since 2021, and they're continuing to be frozen. And that's perceived as a bit of a stealth tax. You know, that will, as we've gone through a period of inflation and wage growth, you know, that's a stealth tax. So if you're earning more, you're actually paying your highest rate of tax on your pay rise or pension drawdown if that's what you're taking. And the other things to note are capital gains tax allowances are being shrunk. That has been planned and been going through for a couple of years now. And we're down to £3,000 per individual this year. Dividend allowances have gone down to 500, having been 2,000 a couple of years ago.
So the allowances are really quite pathetic.
Yeah, well, they're being taken away basically. So they're pretty much becoming redundant,
Yeah.
basically. So you know, that leads to potentially looking at other ways of investing rather than capital gains portfolios such as offshore bonds, where you can put your money into other savings vehicles and control your tax a bit better as well.
Could you perhaps just discuss a little bit more detail offshore bonds? I mean, it sounds, don't want us to use the word dodgy, but as a tax avoidance scheme, perhaps it's really quite a regular opportunity.
Yeah, they've been around for a long time. You know, it's been part and parcel of financial advice and financial advising for a long time. So it's not putting your money anywhere dodgy. You're effectively having it in an insurance product based outside of the UK. You can buy pretty standard plain vanilla investments within that. So you're not hiding it or anything like that. What you can do is you can have access to your initial premiums without paying tax, and you're effectively deferring your tax to a point where it's more sensible or more beneficial for you to do that. So you have a bit more control of when and where you pay the tax.
And your investments grow tax-free?
Whilst they're there, yes.
whilst
So you benefit from the gross roll-up. So you don't have to declare tax along the way. So it allows it to grow at a better rate, much like a pension, basically.
You mentioned ISAs just at the beginning there. There's talk about this British or UK ISA that's going to land. It's obviously an increase in the tax shelter that's available, but the detail, the devil's always in the detail. Do we have any information on that?
Not a lot. Not a lot. There's a consultation.
Okay.
So you know, they're saying that they're going to increase the ISA allowance to 25,000, where 5,000 goes into a British investment, but we need a bit more detail on that, and there's a consultation going on during the summer, so should have a bit more detail in the next sort of few months.
I mean, I guess if their investments listed on the UK stock exchange, that doesn't necessarily mean they're very British. We've got a fairly international
Not necessarily, no.
opportunity set. Okay.
And I suppose the other thing as well, Seymour, is the lifetime allowance. That is being abolished, or has been abolished effectively. So you know, previously it was you'd pay 25% if you had over £1 million roughly in your pension. You had to pay an excess. That got reduced to 0, and that is being completely gone now. So there are threats that might have been.
I mean, that's conservative, that's political in some respects.
Yeah, it was. Yeah, the Conservative government obviously announced that 12 months ago, and the Labour Party or opposition party came back and said we'd reverse that if we got into power. So,
which is looking pretty likely.
Yeah, well, I'll let the people look at the polls, but that looks, you know, that looks fairly likely, doesn't it? So you know, there hasn't been much talk about it since 12 months ago. So whether it does come back or not, we don't know. But we have undertaken an exercise with our clients to try and remove the potential that's coming back by crystallising any benefits they've got in excess of the lifetime allowance. You don't have any extra tax-free cash, but you can crystallise it at a lower tax rate, and you can benefit from putting money in again and the gross roll-up, as I mentioned before. So if there's anyone on this call who hasn't done it, they might want to consider it and get in touch, and we can have a discussion and sort it out for them.
So the opportunities there to effectively increase your pension and effectively have it as an asset which is outside of your estate as well?
Correct, yeah. So it's not liable to inheritance tax, a pension, whilst it's in a set. There's some that are, but majority of them, especially the ones we run, are exempt from inheritance tax.
And just to be clear, what's the amount? Sorry if I...
So it's 1,073,100 to be very precise. That was the lifetime allowance, and you could take tax-free cash up to 25% of that. That's been removed, but the tax-free cash allowance is staying as it is, basically.
Okay. But we're encouraging, as you said, our clients to crystallise effectively where they've had amounts above that lifetime allowance.
Correct, yeah, and the you know, that's not, doesn't give you an immediate benefit, but it means that you can crystallize it and pay a 0% tax on it, and it should protect you if it is ever reintroduced. Whether is it reintroduced or not, we don't know, but it should act as a protection. So it's a bit of a no-brainer actually,
Right.
and we've done it with a number of our clients.
As a stealth tax, it's pretty vicious, isn't it, James?
It's incredibly vicious. I mean, we've had what going on for inflation of about 30% in the last 3 years. So to have the rates frozen now since 21
Yeah, 21.
and up and for 7 years is it's just
It's brutal.
it is brutal for anybody who's trying to earn a living and raise a family and buy a house and do all of those sorts of things. It's getting very tough. I think it's tough in other countries as well. We've got clients operating abroad, and I had a long chat with one of our clients in Canada on Friday, and it seems the situation there is even worse than it is over here. So, and we've survived Labour governments. I mean, I think when we had the first call, there was some doubt about it. It's increasingly looks like there's no doubt about it. I was listening to the radio on Sunday, and it seems to be almost now a matter of opinion that the government is going to change. We've had a Labour government before, and I'm sure we'll survive, but I think it does raise the issue of tax planning. We have to be more alert to it. We have to, constantly think about it in terms of structuring our investments so that, even if we get a good investment return, we don't end up giving half of it away. So that's what it's all about, basically.
It's easy to say that they're going to reverse the lifetime allowance abolition.
Well, they
How easy is it to actually implement?
I think
in practice?
it's frighteningly easy, in fact. So just to give you an example, if you look at the lifetime allowance charge that there used to be if you wanted to transfer your money into a CURUPS, so if you wanted to take your pension fund and move it abroad, there used to be a lifetime allowance charge. That's obviously gone for the last tax year, but it's just been reintroduced. It's not called a lifetime allowance charge, but there is now a tax for larger pension schemes moving abroad. So, I mean, it's basically the same tax under a different name. So it's very easy for any future government to absolutely, I mean, they don't have to call it lifetime allowance. They just call it a different tax and they'll come at it, I suspect. So I think we have to see, there's absolutely no point fretting about and speculating as to what might happen. We need to wait and see what happens. But I think all of the tax planning, we're lucky that we've got the SIPs to protect our investments. We've got the ISAs, which seem to be, untouched. And we've got these offshore bonds, as Sam mentioned. So these are great ways to reduce the tax. And we're very fortunate, I think, as older generation, Seymour, as I put myself in, that we're able to do stuff to try and mitigate the tax as we get older, and less of it's coming from earned income and more of it's coming from investment income.
I think also what's interesting is the opportunity set from an investment perspective. So it's one thing to be able to shelter your income, but actually ultimately it's how well can you invest it? And the fact is you can invest it internationally. I mean, the fact that we're introducing a UK ISA.
Yeah, I mean, that's a really interesting thing. And we've had first question come in. Thank you very much. And please do ask your questions, because the more questions we get, the more interesting and interactive this process will be. Somebody has come online and said, what about the exchange rate in investing abroad? And obviously, one of the attractions of investing in the UK stock market and perhaps having a British ISA is that you don't have to take exchange rate risk. But obviously that means you have to invest in British companies. And we've been looking at some stuff today on British companies, and actually the median market cap of companies in the UK now is about 8 billion, which just about brings them into the line of our global smaller companies funds. So the average FTSE 100 company, unfortunately now, is a global smaller companies. And we've got a handful of companies at the top end that are in the hundreds of billions, but most of the UK market is in that sub 10 billion. And that really now means that the UK is basically a small cap market for our global investors to consider. It's one thing persuading people to invest in the British market, but there's another thing is having good quality companies that are listed that we can invest in that are going to grow our money, and that's the issue.
And many of those companies are international anyway in nature. So when it comes to
Yes.
thinking about foreign exchange,
So the big companies tend to earn their profits as much in dollars. So the US is roughly 50% of the global economy. And then if you add in all the other people who trade in dollars, you're probably talking about, 75% of our investment exposure is to companies, our companies are 75% earning their monies in dollars. So like it or not, we're all exposed to the dollar pound exchange rate. Now that's been a pretty one-way bet for the last 20 years. It's slightly plateaued off at the moment. But it'll be a bold man who bets against the dollar for the next 20 years, I think, Seymour.
all bets for sterling.
Or bets for sterling, yes.
Which is another way of looking at it.
We're not quite into the Swissy environment of being perceived as a safe haven yet. So I suspect we will continue to broadly invest in dollars and pounds. When we do our fixed income, of course, we invest in sterling because we don't need that exchange rate risk, and there are plenty of loans and bonds to buy in sterling without having to take on the currency risk. So our fixed income is almost 90% in sterling based, but as soon as we go into the equity markets, then we're completely international.
And obviously exchange rates very much affected by interest rates. And we have a little experiment here. We're going to conduct a poll. So we're going to invite everybody on the call, if that's okay, to put in their predictions as to where interest rates might be in a year's time. When we did this first webinar this year in January, there were expectations of several rate cuts. And we haven't had a rate cut actually since then. But we've got four options here. We've got
some very intelligent clients who are already way ahead of you, Seymour.
The front runner is quite conservative, 1% fall in rates. There are some banking on a more than that. Inflation, I guess the extent to which inflation is under control, we'll be able to see interest rates fall further. Excellent.
Whoa,
whether it goes below 3.25, maybe that's more of an indication of recession, you think, if interest rates are going back that low?
Yeah, I mean, it's fascinating. I suspect our audience is going to be pretty much where the market is in terms of rates. So, I mean, if we look at a 5-year gilt, we're at about 3.9% on the 5-year gilt. So we've got base rates at 5.25, and we're saying that over 5 years we're going to earn 3.9. So if you work out where it might be at the end in order to get an average return of 3.9, that's roughly where the market is looking. So it's probably actually the market's probably a little bit more optimistic about base rate cuts than our audience going by that, because we're getting a fairly overwhelming view that we won't get below 4.25 within the year end, which is quite interesting. And that's definitely been the mood shift at the start of this year, because as we went into the end of 2023, there was this expectation that interest rates would come down very rapidly. And actually that hasn't transpired. And here we are, it's already in April and nobody's blinked. There's this thing about who's going to blink first, whether it's going to be the Bank of England, the Central Bank of Europe, or whether the Fed will blink first. But so far, nobody has blinked. And we're sat here with very strong employment figures in the US, relatively buoyant economy, parts of the economy, struggling. And obviously we've seen the impact of the tax take on people's income. So I don't think consumers are in rude health, but we aren't seeing that sort of recession yet in the US particularly. So, they're obviously wanting to be cautious.
James, put your neck on the line now. We've asked our viewers to suggest where they think interest rates are. Bearing in mind that I said at the beginning that the views expressed are private opinions. They're subject to change. Where are you hedging your bets in terms of where interest rates?
Well, I think base rates will come down, and I think maybe they'll come down a little bit quicker than our audience thinks. So I think I would be in the sub 4% camp. Yeah. Okay. I think that the longer term interest rates will stay high. And in fact, if anything, they might go even higher because there is an enormous amount of debt now, and particularly in the US. US debt levels are getting to quite extreme levels again. And so that debt has to be financed. And so, I think in order to attract investors in government bond, in government debt, interest rates, longer term interest rates are probably going to stay quite high. But I think the base rates, we might reach a bit of a tipping point and then they come down quite quickly and surprise people on the downside.
And we've got a question come in regarding the relationship, how rates might move in the US versus the UK. So if the Fed moves their rates lower and faster than the UK, would that quickly divert investments from the US market?
So no, I mean, if anything, the other way around. So if you think of the bond markets, particularly if they think if the investment market thinks interest rates will be higher in the UK than the US, they will tend to support UK bonds. So they'll buy UK bonds in sterling. So if that happens, if the Fed drops more quickly than the Bank of England, then sterling would appreciate, and that would actually dampen down a lot of our equity returns, which are obviously in dollars. If it goes the other way, if the UK blinks first and we end up coming down more quickly than the US, then the opposite will happen, and we'll probably see the pound depreciate against the dollar, and that would stimulate our equity investments because they're largely dollar based, as I've already said. So that's a really good question, actually, and I think that's
interesting.
That timing of base rate cuts is going to be quite, that will be quite instrumental in seeing what moves and how we get the market movements going forwards.
I mean, one of the thoughts behind this poll was to lead into the whole issue regarding investment performance and the outlook. So I'm glad it stimulated quite a bit of discussion already. But James, over to you in terms of, have our funds performed in line with expectations, the ones that we were putting out in January? And how does it reflect against the market, what the market's done? And in particular, our positioning of portfolios overall?
Good. Well, I mean, I'm going to take it as read that the guys who've come on this call have probably read my update on Friday. If you haven't, please do read it and ask your advisors. If you're not getting the market update every 2 weeks, then check in with your advisor and he'll get you hooked up so you're getting it. But for those of you who did read it, you'll have seen that our investments are performing pretty much as per the tin, if you like. So the lowest risk investments gave the lowest return and the highest risk investments gave the highest return. It isn't always like that. So 2022 in particular was a bit of a shocker in that our lowest risk investments ended up doing almost as badly as our highest risk investments, and that was a good lesson to learn. But right now we seem to be rewarding risk at the top end, but because of these lovely interest rates that we've now got, we're getting rewarded simply for taking a small amount of risk into fixed income. So it is much easier for us to do our jobs right now. We can be pretty confident about the returns in our fixed income portfolios. And we will watch and wait to see what happens in equity markets, which is obviously much more heart pumping and exciting, but is pretty unpredictable because it is equity markets are the things that are going to bounce off geopolitical risk or off things that we haven't thought of yet. So by definition, they tend to be more reactive to events than fixed income, which is a bit more stable.
To some extent, we've seen markets insulated from the geopolitical issues, which I have to say seem to have got worse. And we've actually got a geopolitical question coming through. Do you have a view on what impact a Trump presidency? Okay, here we go, right across the board.
Well, all I can say is I'm
US,
glad
UK, and EU. So quite comprehensive.
Yeah, well, I think the only thing I can say is I'm glad I don't have to live in America. So that's the first thing to get out of the way. I can only imagine you get what you vote for in America. So they're very welcome to him. But I think Trump will. He's basically, what's he out there saying? He's going to perhaps not spend as much militarily on keeping world peace. So he's a bit anti-world peace. He's probably pro-business. He's probably pro short-term fixes rather than long-term investment. But he's got a heap of troubles on his back as well. I mean, he's just lost a couple of billion quid in the last 2 days. I just was checking before I came in, but his listing that went so well has tanked nearly half its value in a matter of a week. So he's a busy man with a lot on his plate. And as always, I think with all these politicians, the country will continue despite the politicians, and probably their impact is always a bit less than we expect. I think the economic and fortunes of the three regions that are name checked there are probably set in stone now in terms of how the economies are recovering. And so, Trump will come in and inherit a relatively strong economy. So, it's unlikely that we're going to see massive changes, I would say, in market conditions or market pricing because of the results of these elections. And that, that seems to be true. I'm sure that'll be true in the UK as well. It'll be more about what those governments inherit in terms of whether the country is actually growing and getting better, or whether the tax pull in the UK is finally pushing us into recession. So that, clearly, I think that Trump will inherit a stronger economy than the Labour government will do. So, he's probably got a better hand of cards, in his first term than the Labour government will have here. So the answer is I don't think it'll change things very much. I think we're in this post-COVID recovery with these sort of geopolitical risks. That's where we are at the moment. I don't think either of these change of governments are going to change that very much. That's just the world we're in, and the geopolitical risks so far haven't really massively impacted returns. It's much more about how the economies have recovered from COVID, and the AI and the way computing might go, and where we see productivity and business going in the future.
It's just a thought, James, but following on from that question, I can imagine you'll be quite keen to take on some of the technology, the power that currently in technology businesses in the US in particular, as that's closest to hand. And that kind of reflects on what we were discussing at the previous webinar regarding the Magnificent Seven, and in particular the technology bias, the bias to US stocks, and how do we react to that on behalf of our clients? Is it a trend that we try and catch up with, or is it something that we resist in terms of how we construct our portfolios?
Seymour, can I ask you to hold that question for one moment, because we've got a very interesting question coming online there. And it's basically, I read the question, it says, is it possible to see the live ongoing performance of each of the model portfolios in the portal? Now, Mark, and I don't know which Mark you are, but that's a brilliant question to ask. And you're completely in my headspace, because on Friday when I did that, and put the whole range of portfolios and their performance. That was a very deliberate ploy on my part, because I want the clients to see what returns are going on in other areas of the market. I think it's really important that as our customer base are aware of what is available in terms of returns in all the different portfolios, because it's very easy in the way we operate wealth management generally to sort of agree with your advisor, that you want to sit in a balanced multi-asset portfolio, when actually your objectives and risk profile might be better set by being in one of the lower risk portfolios or one of the higher risk portfolios. And so I think it's a great question. I don't see any reason why we couldn't do it. Certainly we'd have to do a bit of work behind the scenes to deliver it, but I'm getting a bit of a nod here from our operations manager, so that suggests it's probably possible. And I think it is important for people to understand. So what I take from it at the moment, which I think is really, really important, is that actually the fixed income returns are pretty good. Now, we predicted that fixed income would do a lot better, but I think some people, and possibly we, thought it might be a short-term hit, sugar rush, and then we get these lower rates again. that isn't proving to be the case. So the long-term rates and the rates we've got are still incredibly attractive. And when you look at what the average return of the S&P 500 has been historically, it's only about 10 or 11%. So, okay, we've had 16% per annum out of the S&P 500 for the last 5 years, but that is an exceptional return period. And, you know, more generally, we're looking at 10% as a long-term return from equities, and our fixed income portfolios are delivering something pretty close to that for a lot less risk. And so if you know, I'm quite keen for investors, you know, particularly we know people are investing their pension funds, you know, how much risk do you want with these portfolios? And, you know, believe me, there's quite a bit of risk investing in global equities at the moment because prices are quite high. There's quite a lot of geopolitical risk. As we pointed out, there's elections going on in around the globe. So, you know, investing in equities is not without risk. And I think it's really good for all of you to talk to your advisors and make sure you're taking as much risk as you need to, but not a whole lot more than you need to, if that makes sense.
Yeah, and interestingly, on that point, inflation is coming down. We're looking, I think,
Yes.
Bank of England is predicting just above 2% inflation by the summer.
Absolutely.
Which means you've now got a positive real return on your fixed income investments.
Correct.
And a significant positive real return.
Correct.
We haven't seen that for
even our lowest risk
a long
portfolio, which is moving along at about 6% per annum, after all fees, is delivering inflation plus 3%. And you know, that's the objective of most of our portfolios at the whole risk spectrum. So we do have this period now where we're actually making money in real terms, taking a very modest amount of risk. And I'm keen that our customer base should understand that in their discussions with their advisors. And maybe now back to your original question, Sim.
Yes. So we were just talking about Trump and the impact on potentially technology stocks in the US if he was to try and reduce the power that really currently resides within those corporations. And linked to that, the Magnificent Seven and the extent to which they've dominated investment performance globally, as they occupy such a large part of both the S&P 500 and the S&P 500 in turn occupying a large part of the MSCI world. What does that mean for us in terms of how we position our portfolios and how we've been sucked into that? And linked to that, perhaps we'd be better placed investing in the index itself. To what extent does active play a role? We've discussed how active plays a role in fixed income before, but within equities, how do we position ourselves?
Thank you, Seymour. And that is a question that has come up a lot. Honestly, in the last 6 months, I think it's probably number one on our list of questions is why don't we just throw the towel in and go and buy a tracker fund? Because you know, the S&P 500 has been on this tear. It's been extremely hard for active managers to keep up with it, and it's cheaper, so it just feels intuitively like the right thing to do, right? It's the top performing market. It's the cheapest way of investing. Why wouldn't you just pile into it? So that is the dilemma that we're faced with. So we actually took that on board, and we've just in the process of finishing a presentation on that. So the first thing to say is that we do have some S&P 500 index, and it is that index which is driving the world index and dominating everything, because that's got these very big companies in it. It's got these Magnificent Seven holdings in it. So we have an exposure to the S&P 500 index. We think it's right to have some of our money tracking that index, and we may well increase that. If we see a good opportunity to increase it a little bit, we might do. But what we have done is we've sort of asked ourselves, okay, what is it, you know, we've got these active managers, what is it we're actually delivering if you buy our portfolio of equities, if you like, versus the index portfolio of equities? And basically it comes down to three things. So firstly, we have the geographical exposure, and we're a bit less exposed to the US than the MSCI World Index. So the MSCI depends which index you look at, but the exposure to the US is about 65 to 70%. Now, actually, in terms of global GDP, the US is actually only about 50%, and that's roughly where our US exposure is. It's about 50%. So, and our view there is we want the best companies in the world that access global GDP. We don't necessarily want companies listed in the US just for that sake. So, and there are plenty of companies outside of US listings Novo Nordisk, for example, selling its slimming drugs. We've got LMVH selling everything luxury. There is no LMVH equivalent in the US index.
L'Oreal as well as a luxury.
Yeah, there's one European acronym called the granolas. I won't try and remember all the words and all the companies, but basically there is a bunch of global companies that are feeding off that US GDP as well as the rest of the world GDP, which is over half, but don't happen to be listed in the US. So we would rather let our global managers pick the best companies than say to them, thou shalt have 75% in US stocks. So that's the first thing. The second thing, which we touched on earlier, is market capitalization. So it is, as Seymour, as you said earlier today, it's easy to sort of go a bit queasy when you see these trillion-dollar numbers, but the value of these companies has grown absolutely astronomically. And so it's very difficult for other companies to get a look in when the index is buying on a market cap basis. So, and it doesn't feel to us like a good investment discipline just to buy the biggest companies. So, you know, we've got quite a bit of research to suggest that actually the biggest companies, I mean, Microsoft is perhaps an exception here that's been at the top of its game now for nearly 2 decades. But in most cases, big companies, when they get there, fail to stay there for more than a decade before they're back down into the 50s and 60s. So just simply buying the biggest companies doesn't seem to us to be a smart way of looking at the world in terms of where the best opportunities are going forward. So when we look through our portfolio, it's about 15% underweight to those what they call terra cap or mega cap companies, and the balance is all in big cap, medium cap, and small cap, noting that small cap now is about equivalent to the FTSE 100.
So we don't have too much Tesla. Is that...
So we don't have as much Tesla as the index has,
That's
which is good news, unless of course you believe in the driverless car. And then and the final thing, which is probably the most important thing, is price. So when we look at our portfolio, the shares relative to the earnings of the companies that we're investing in are roughly 20% cheaper than the index. And if you're a maths person like I am and believe in mean reversion and things will ultimately come out, that broadly means our equities, I think, will make 2% a year more on average over the next 10 years than the index companies. So it's basically price, market cap, and geographical location.
On geographical location, we should take this opportunity to answer a question that's just come in. What do we now think about Japan? A couple of things. I mean, Japan's late 80s, 89, it's taken about 40 years to get back to where it was. But it's also interesting to see interest rates are flirting with basically normalizing to positive again.
Yeah, and actually,
so what does that mean for our
Japanese? First and foremost, we like Japan. So, or I say we like, our active managers like. So when we look through our portfolios, we find ourselves slightly overweight the Japanese market. The biggest company in the Japanese market is Toyota, and obviously, if you've been reading What Car magazine or anything else, you'll know that there's a massive change of heart in car manufacturing, coming away from electric vehicles and moving towards hybrid. And Toyota and some of the other Japanese car manufacturers have been big winners on that side. So whilst Tesla is going down, Toyota has been going up equally in the opposite direction. So, and in fact, our top performing fund, which we name checked on Friday, the Artemis Global Income Fund, has made its outperformance by being overweight, considerably overweight in Japan. So I think the answer is we like Japan.
And just to be clear, it's not that we think Japan should be overweight per se. It's a combination of the managers that we like.
Yeah, we don't have a Japanese fund allocation. So Nick isn't saying we're going to put 15% or 20% into Japan. It comes from the fact that we've got these global managers who've got the free hand to invest wherever they want for what they think are the best opportunities. And that right now is leading us into Japanese stocks.
And linked to that, we've now got a question. What about investing in India, which is the fastest growing economy?
Well, I think that's a little bit behind the curve. So absolutely, it is the biggest democratic economy in the world, I think now. But after America, is it still bigger? I ought to know, but I'm not
As
sure.
a democracy, it's the largest democracy,
It's-
inverted commas.
Yes, exactly. But the stocks in the Indian market have been going up and up and up. So I think probably they are well priced is the answer, whereas the Japanese market has been underloved. And so the difference in price earnings ratio would be pretty enormous between those two bets. And clearly our managers are seeing more value and more opportunity buying in Japan than they are in India at the moment.
I mean, my only other general comment to add to that is that in terms of the global economy, in terms of how corporates are set up, it's interesting to see that it's sector rather than geography, which is often a more determinant factor in terms of share prices. But nevertheless, geographic exposure is important. And
Yeah, and I think
diversification is important.
sectorally, we're not that much different to the world index in that our exposures to tech and luxury goods and those sorts of things are pretty much, when we look at that, there's not much difference between our portfolio and the index. But I think, just to summarize on this point, the difference between having your money, I guess, look, if we're being honest, it's a twofold win in terms of cost, because not only do you get your money managed cheaper, but you could argue that you don't need a tideway. So if you just want to go and buy the index and forget planning and forget, active fund management, then you can save, probably 50 basis points, 0.5% on the management, and then you can chuck us into touch as well. But I would like to think that over time, we will add substantially more than our costs in terms of value, both in a combination of the underlying returns of the funds that we generate compared to the index, but also in the amount of that you hold on to after tax, which is the key game, because that is that's the number that ultimately is what you're going to have to spend or pass on to the kids. So it is the combination of those two things: the tax planning, as Sam alluded to, and then also the general sort of planning of cash flow, which is one of the reasons why we've launched our dual drawdown account, because that allows us to help manage the way we access the more volatile investments, which ultimately will show much bigger, I think, improvements than an extra 0.5% or 1% per annum.
And obviously there's the administration and there's the client service that clients get. We'd like to think that adds a certain amount of value to what they receive. We've got a question here which is more operational client service related. So we're told in the last Zoom call that portfolio fact sheets would be made available again on the Tideway portal. What's the timescale for this?
I can't answer that unless I've got an answer. Sorry? Next week.
Well,
we're being told possibly within the next week.
I think we'd better come back to you with an answer to that.
I think,
but
we will. Maybe we'll do a post out. We're obviously right in the middle of doing our quarterly valuations for the end of March, and they'll be coming out into the portal in a week or two. But we've had that question about the actual portfolio returns, which we can definitely get into the portal, and the fact sheet. The fact sheets are downloadable on the website. Yeah,
they will be up very shortly and running for.
Although those are the public versions and not the. So we have two sets of fact sheets. One is a public version, which has got a little bit less information on it, and one is our client-facing fact sheets, which have all the full detail on.
It's interesting because we do have the opportunity to conduct one other poll. It's a feedback poll, but it's very much related to that question that we've just had. And it's, do you think we currently provide enough information on investments? And bearing in mind that we obviously have a portal which provides transparency on a daily basis. James is producing every 2 weeks a market insight. On the quarterly basis, we are reporting on performance of all of our funds. And obviously you have the opportunity to speak to wealth managers, and there's an annual review. If you wouldn't mind, it would be helpful actually just to, if you get the opportunity, just to respond. It's a very simple yes or no. And obviously, if the answer is mainly no, then we need to understand what other information we could provide. So if you're prepared to respond to that.
Yeah, if there's an overwhelming no, then maybe we could ask some of you whose emails we will have to give us some feedback on what else you'd quite like to see. But we take away the fact sheets and the other portfolio returns, which I think is really important, and I'm with that. So you're going to launch it.
So question is, how is not launching at the moment?
Whilst we do that, there was one other question that came in advance of the meeting, which is about our fixed income funds, and particularly what used to be referred to as the Sanlam funds, or the Peter Doherty funds, for those of you who've been with us for a while. So these were the funds that we originally launched at Tideway, and we still own two of them. One is the credit fund and one is the hybrid capital fund. The hybrid capital fund has now moved twice, and it's gone from, it came out of Tideway, went to Sanlam, and then Peter's moved on, and it's gone to Titan Wealth Management. And the Sanlam Credit Fund is still at Sanlam. So the question is why, you know, honestly, James, why are we still in these funds? So the answer is that we have absolutely nothing holding us into those funds or any financial interest in the funds. So we, right now, I can honestly and genuinely say we are there for one reason only, and that's been the performance of those portfolios. Both of the portfolios are under review, or the funds are under review, because if we were starting tomorrow, I wouldn't be, you know, suggesting to Nick that he goes and buys a fund from Titan Wealth, who are absolutely competitors of ours. So from that respect, we'd probably be out of there. And the same, Sanlam have actually closed down their UK wealth management business, so they're no longer competing with us. But it's probably not a natural place for us to go to for an active fund manager. That said, what we have done, and because we knew the funds really, really well, we have enjoyed stellar performance from them in the last 18 months. And I think both funds have been pretty much top of the pops in terms of their returns in the areas that they've dealt with. If we look at the credit fund, that made just under 10% last year and has made nearly 3% so far year to date. If I look at the hybrid capital fund, we have, if I can find it, here we go. No. There we go. That made 13, just over 13% last year, and has made about 4% this year. So they have not caused us any problem at all. They've actually been outperforming most of our other fixed income holdings, which have all been doing pretty well. So we're delighted with the returns from them we've got, but they are on our watch list for absolute sure, because we would jump into more specialist managers and firms who are probably going to charge us a little bit less at a heartbeat if we felt we could get equal risk returns as has been available from those two funds.
So we've had the results in from the poll. Thank you very much. They are very encouraging. Out of 28 people answering, 26 appear to think they get enough information. Nevertheless, we will look forward to addressing certainly the requests or requirements of the two that feel they don't get enough information. And I guess part of that will be the fact sheets on the portal, which should be forthcoming in due course. But that's very helpful to know. And I think just in line with James's comments, you know, we do try and be as transparent as we can.
Take that one.
And sorry, we've got another.
We've got one last question, which
this could be quite an interesting one as well, because can you tell us more about the drawdown approach today and the split of the funds?
Sam, do you want to try and do this one, or shall I do it? Well, you start, Sam, and I'll come back, because I'm sure they're bored of me.
Well, I think when you look at drawdown, you need to look at what you want and how you want it. So how much income do you need? And then you can allocate accordingly. So, you know, we are in the process of looking at a dual drawdown, which James spoke about briefly, but you can put certain money into very secure income and split the fund that way, and then you can have a longer term view with some higher risk things, and you can have that comfort and look at it a bit longer term, if that makes sense.
Yeah, so this is a facility that we've literally in the last 4 months had access to through our partners AJ Bell. So it's functionality that wasn't available to us in 2023. It's become available to us in 2024, and it allows these two accounts. So basically we can have two separate portfolios sitting in the one SIP, and manage both of them on a model basis. So without getting too technical on you, the model portfolio process allows us to manage lots of portfolios and keep them all in check and aligned to where we want them invested, rather than doing it on one account at a time, which would become very time consuming. So the model portfolio process is really important. And now we can do it in two separate accounts. It does mean that we can basically separate out these sort of lower risk, the bottom low risk bond portfolio, which you saw in the market update on Friday, which is delivering about 6% with very low volatility, and then these higher risk portfolios, which have got higher returns but higher volatility. And we've been doing some maths just to back this up, and you'll see it coming out in the press, and we'll share it with you as clients. But basically, it shows that if you start regularly withdrawing from volatile investments, obviously as the market turns down, you have to sell more and more investments to keep the same amount of withdrawals coming out each year to fund your income.
So you're less exposed to
So
market drawdowns.
yeah, so with the two approach, we can take the withdrawals from the first portfolio, and we can come to the second portfolio for withdrawals when we want to, rather than on a monthly basis to fund your income. And it just gives us that bit more flexibility to avoid selling things as a loss. Constantly what we're trying to do is avoid being forced sellers of things in a downturn when we know they might recover. And obviously we had a good lesson of it in 2022 when lots of our investments were down, and we would have in that year probably ended up having to sell a few people's investments that would have recovered quite strongly thereafter. And so that's what we're trying to avoid doing with the drawdown. It's going to have the most impact for those who are drawing the most. So if you're drawing a higher percentage from your account, it's going to be more relevant to you. And also if you're trying to invest in the higher return portfolios. So if you're happy sitting in our bottom cautious multi-asset portfolio and you're drawing less than say 5% per annum, it's not going to make much difference to you. But if you want to own the equity portfolios or the higher risk portfolios that you saw in that list on Friday, and you still want to draw 5 or 6%, noting now that an annuity rate is probably 7%. So that's suggesting to us where we could be for sustainable income. Then, the dual account will definitely improve your returns.
And just to be clear, James, there's no change in fees.
There's no
for
change
those
in
people
fees,
who
no.
have a dual account.
No.
It makes sense for them to
Yeah.
have one. Now, interesting question coming in. We discussed over a year ago the number of funds in the portfolio.
Yeah.
Currently 22 seems higher than needed, possibly. Your thoughts?
Well, again, I've been on that camp of getting less funds. Nick is less convinced than I am, so it's a good indication of the sort of dynamic. How should
In
we
the
call it?
investment committee,
The
yeah.
dynamic toing and froings of the investment committee. I don't get it all my own way, so Nick quite often gets his way. I mean, one of the things
across all the portfolios.
Yeah,
so
I mean, one of the things that Nick has been really good at doing, as he's managed to get us into some lower cost share prices. So we just made a switch in the Royal London Fund, which knocked about 0.3% off the cost of that fund. And we're doing a similar switch in one of the other funds at the moment, which is getting us into a founder share class at a lower price. So that the idea of getting into some of these where we can see the same strategy going on, but we're helping the fund manager launch something new, and it works for us and it works for them, we will take advantage of that. I think what really comes down to is when you look through. So I am convinced that it's really when you lift the bonnet, put all the funds in, and see what it's like. So one of the things that we've now got through the work that Nick and Costa have done is that when we sit down as an investment committee and we debate about taking a fund out or putting a fund in, we can, in the equity space, we can look at those metrics of geography, market cap, and price, and see the impact of changing that fund in and out. So we can see what it's doing to the underlying portfolio. So it's something we've got under review, and I probably prefer to have less funds. Nick's not in that camp, but we'll see how we go over the coming years.
typically, it does mean that we're more diversified than we might be otherwise. So we have less, certainly stock-specific risk.
Yeah.
But whether that
Are other fund managers buying into the other two Tideway funds? So the answer to that is a yes and a no. So in the hybrid capital fund, the fund has grown quite substantially with the move to Titan. So that fund has gone from just over 100 million to knocking on 200 million. So it's almost doubled in size, which is good for us because it means we're a lot smaller in terms of the amount of investment we could leave at any time. With the Sanlam fund, we are being told with Sanlam that they will merge it in, but that is one of the things that we're monitoring with them. If they don't grow the fund in the forthcoming future, we will definitely come out of that fund.
Thank you, James. So the question here is a general percentage point for drawdown, which across all portfolios would make it preferable to run dual portfolios.
Yeah, so that's a great question and fairly easy to answer. So on all of our portfolios, we have a yield number, and because we're invested in the SIP, we can separate out the investment income from the capital growth. And if you're withdrawing less than the investment income, then there is very little benefit of the dual drawdown because basically the investment, the coupons and the dividends earned by those investments are very stable. They generally increase from year to year. And so if your withdrawal rate is within those, and obviously you've got to pay your fees on your account as well. So you've got to cover your fees. If you can cover your fees and your withdrawals through the yield on the portfolio, then the dual drawdown account really won't make a jot of difference. If you're wanting to draw more, taking account the fees and the withdrawals that you want to make, if you want to draw more than the yield on your portfolio, that's when the drawdown, the dual drawdown really starts to bite. So I guess on our multi-asset portfolios, that's now around about 4%.
Yeah.
So if you're drawing less than 4%, it's probably not a big issue for you. If you're drawing more than 4% per annum of the portfolio value, then you should be talking to your advisor about splitting into the two accounts. Good question.
And as James alluded to earlier, there'll be potentially a bit more on that hitting the press.
Yeah, we've got some press releases coming out this week, and we're hoping to get some comments in some of the broadsheets on that with a bit of luck.
Thank you, James.
2 minutes to go.
We're approaching the end of our allotted time. If I'm going to reflect on what was turned out to be admittedly quite a lot on investment stuff, which is normal, a much broader itinerary in terms of different issues. You know, from the investment side, obviously, the start of 2024 has been a positive one right across the board, both in terms of equities and fixed income, and perhaps certainly ahead of expectations on the equity side, based on the geopolitical pressures that exist. Regarding financial advice, clearly there are plenty of opportunities, there are plenty of challenges. So, you know, especially if you're interested in the dual account, definitely want to contact your wealth manager about that. And from a business perspective, I like to think that actually we're in a much stronger place. We're in a stronger place, James, without you as CEO. That sounds like a terrible thing to say. I'll probably get the sack.
Well, we have just seen about a 10% increase in our assets under management. So
that's been good news.
That's very good. That means, you know, that's basically puts us in a much stronger position. We've managed to do the buyout of Peter completely. So the management of Tideway now own the business 100%, and we've done that without having to borrow any money, which is a great position to be in. And we've got the biggest pipeline that we've had for many a year. So that's also very encouraging. So generally, we're feeling quite good about life at the moment, I think.
So that really just leaves me to certainly thank you very much for your attendance this evening. Thanks for your continued loyalty. And we look forward to seeing you in due course in 2024, whether that's going to be online or in person. But once again, I think that was a very, very interesting webinar. Thank you very much indeed.
Thank you.